All right, everyone. So in this video, we're going to look at the COT report. Okay, for many people who trade the markets, understanding how hedge funds are positioned in the currency markets is an absolute game changer. So I'm going to take you over to the computer screen. I'm going to show you some recent articles talking about the COT report, how you can use this report to know exactly how many contracts are open to buy an exchange rate or to sell an exchange rate against the US dollar. Okay, we'll go through all the major currency pairs and it will transform your trading, because every week you're going to have the data to know how many hedge funds are buying a currency or how many hedge funds are selling a currency. So let's go over and look at the COT report. Right, everyone, a warm welcome to today's video. We're going to be touching on the COT report, a very powerful strategy you can use if you're a retail trader to understand exactly how hedge funds are positioned in the Forex markets, so it can help you get an edge in your trading. Okay, here is a report, okay, that came out on Bloomberg recently after the COT report was released on a Friday. It comes out every single week, and this report is going to tell you exactly how many contracts hedge funds have open for a currency to either strengthen or weaken. Okay, here is what the headline says: hedge funds cut their wagers against the yen by 94,000 contracts. Okay, so clearly hedge funds have stopped buying the Japanese yen, because look at the headline: bets against the yen crater. Okay, as volatility scares the favorite carry trade. Okay, those moves led to an unwind in the so-called carry trade. I literally did a video on my YouTube explaining this whole move in USD JPY because of an unwind in the carry trade. If you haven't watched it, watch it, but I will break it down briefly in this video. Okay, so clearly the hedge fund community are no longer speculating on a weaker Japanese yen. It says here, speculative traders sharply pulled back bets on a weaker yen. Okay, because there's been an unwind on something called the carry trade, and this headline is telling you the exact amount of contracts they've cut betting against a weaker yen, causing a big appreciation in the exchange rate USD JPY. So how do you get this data and how do you break it down so you can get an edge and know exactly when the hedge funds have gone from buying the dollar against the yen to selling the dollar against the yen, so you can catch moves with the hedge funds? Because remember, they're big investment funds are what really push the currency markets. Small trading accounts of a couple $1,000s are not going to move Forex currency pairs. When hedge funds are trading billions of dollars, when these guys move, the market moves. Okay, so every Friday you can come over to the Commodity Futures Trading Commission. You can get the data to download exactly how many contracts they have open to buy or sell a currency. Okay, I have a spreadsheet open over here, and we organize the data for every single currency. Over here, we got the Swiss franc against the US dollar. We got the US dollar against the Canadian dollar, the pound, USD JPY, Euro USD, Aussie dollar, US dollar, USD Mexican peso, Brazilian real, New Zealand dollar, the US dollar against the South African rand, and then the US dollar itself when you're looking at the DXY, the dollar index. Okay, so the COT report is telling you how these currencies are positioned against the US dollar. Now, the only currencies you can get this data for is what's on the COT report. Any other currency, if it's not on the report, you can't get it. You don't know how the hedge funds are positioned. Okay, but it's got the main pairs in contracts for the Aussie dollar. Okay, so the long contracts are how many contracts are there to buy the Aussie dollar to bet it goes up in value. Then you have how many contracts are there to sell the Aussie dollar to bet it goes down in value. Okay, and then you have the weekly change every Friday in the total amount of leverage long contracts compared to leverage short contracts. So you can see the amount of long contracts, the change, the weekly change in the amount of short contracts. And then you have over here the percentage amount of long positions and the percentage amount of short positions. And what you're trying to do is, when you get this data, is you need to understand that there's a terminology in the hedge fund community called the flip. And the flip basically is when you get the difference between the total amount of long positions compared to the total amount of short positions. Okay, and anything above zero is telling you that the hedge funds have more long positions open, in this example, for the Aussie dollar to go up in value compared to positions going down in value. So the short trades that they have open. Anything when you have a minus number is telling you, for an example, that there's more contracts open to sell the Aussie dollar than there are contracts open to buy the Aussie dollar. So the flip is very, very simple. When the flip is above zero, okay, on our data. So basically when we download the data each week, you can literally imprint the numbers, which I'll be showing you how to, okay, into the latest row, okay. So this chart is showing you the brown line is the flip data. So is the total amount of contracts positive for the Aussie dollar to get stronger against the US dollar, or negative to get weaker against the US dollar? So here is our zero number. Again, anything above zero is we're expecting a strong Aussie dollar. The hedge funds have literally more contracts open to buy the currency. Anything below zero, they have more contracts open to sell the currency. And what we do is on the chart, we have the Aussie dollar US dollar exchange rate value, so you can actually see whether this works. Okay, so let me talk you through it. You can go back from 2004 to 2024. Now look, the moment you get the data going above the level of zero, this is telling you that there's more contracts open to buy the currency compared to sell the currency. So you can see here from 2006, 2007, the COT report is going up for the whole entire year, telling you investors at that time in the hedge fund community are piling on bets for a stronger Aussie dollar against the US dollar. No surprise, Aussie dollar, US dollar goes up in value during the whole entire period of time. Then what happens? The COT report peaks and then starts to go down. Now remember, when you're looking at the amount of contracts open go from a peak and then declining, well, obviously there's a reason why it's declining. Why are hedge funds going from being very, very bullish the Aussie dollar to suddenly becoming bearish on the Aussie dollar? Now remember, it's still above zero, but they're cutting the amount of long contracts they have open and it's going lower and lower. No surprise, the Aussie dollar US dollar exchange rate starts to tumble. Now, when the number goes from being positive above zero to going negative, so it now turns into a negative number, this is your opportunity to sell an exchange rate, because the hedge fund community have been committed to buying a currency and now they're committed to selling a currency because there's more contracts open to sell the currency than there are to buy the currency. And that's when you see sharp moves in an exchange rate as they go lower. No surprise, as soon as the COT report starts to rise again, meaning that the amount of short positions compared to long positions are narrowing, and then it goes positive again, Aussie dollar, US dollar takes off again, and you get big moves in the exchange rate. As soon as it drops here, the exchange rate drops. As soon as it rises back up to here, the exchange rate rises. As soon as the COT report starts to decline over here, no surprise, Aussie dollar, US dollar is going lower. Okay, so what you need to do to anticipate the moves in the currency markets is, number one, is the COT report, is the flip number going above zero into positive territory, telling you they're committed to buying the Aussie dollar? If that's the case, and you understand the fundamentals why they're doing that, well, good, you can buy the exchange rate. And the more contracts keep going higher and higher in terms of the flip number. So let's say here, look, it goes from negative to positive, 6.5, 8.5, 25, 27. This is showing you there's momentum building. And in those scenarios over many, many weeks, many, many months, that's when you're catching big trends, because there's a reason why hedge funds are now buying more and more contracts for a currency to strengthen. And if that number hits a peak and then starts to decline, okay, well then you're knowing there's a trend, there may be a change in trend. Why are hedge funds no longer buying contracts? Why they're now closing contracts and even adding to short contracts in the currency pair? There's always a fundamental reason behind it, right? So what you need to pay attention to is the peaks and the troughs. Notice how the COT report, once it gets to the level of 60, Aussie dollar, US dollar since 2004, that's 20 years, it never gets above 60. It peaks at this level and then comes lower. Peaks at this level and comes lower. Peaks at this level and comes lower. So you don't really want to be buying an exchange rate at the peaks, because historically the exchange rate doesn't really go that much further once you get into these peak levels, because contracts then start to come down. Troughs are around the level of minus 40. Around this level is the troughs, okay, around 40, maybe 45. You can see the troughs are happening. So you don't want to be buying and selling the exchange rate at the extremes. You want to be buying the exchange rate when the flip happens, when you know investors in the hedge fund community have gone from being committed short to committed long. That's when you can buy. Or when they're coming in the opposite direction, when they've been long and they're coming in now and they've been committed to going short because there's now more short contracts open, which you see here, that's a good time to sell the exchange rate. Okay, now you can get in at the peaks and the troughs, but you need to fundamentally understand what's going on. Now, I actually want to show you a really good example of what drives the COT reports. And in the headlines over here, it talks about the carry trade, which is a whole video I did on the dollar going up again in value against the yen recently. And I'll show you a brilliant example of this Aussie dollar, US dollar currency pair trade when we're looking at that big move we just looked at here. So let's go back to the 2008 financial crash. Remember, banks went bankrupt. The dollar strengthened 50%, or 40% against the Australian dollar, because the dollar is the world's safe haven currency. So whenever there's market turmoil, you know the dollar's in demand. But what happened in 2009 that suddenly caused the Aussie dollar to start to strengthen against the US dollar? And this trend happened to go up for about 2 years. The Aussie dollar went up 75% against the US dollar. Now, this is called the overnight carry trade. So let me break this down for you and you can understand it. Now, unfortunately, many people that try to trade the currency markets don't even understand that the interest rate set by the central bank means that when you're trading a currency pair, you're even making free money into your trading account every day you hold the trade open, or the broker is going to be debiting money out of your trading account every day you hold a trade open. Many people don't understand it, but once you understand that the hedge funds are using the carry trade strategy to earn free interest every day, now you'll understand the importance of interest rates. Okay, so let's have a look. In 2008, after the financial crash, the US central bank slashed interest rates in America from 5% down to 2.5%, 0.25%, basically zero, right? However, in Australia, the central bank only cut interest rates, okay, from 7.25% down to 3.25%. So there was a bigger interest rate in Australia relative to the United States, okay? Now, this is where investors and the hedge fund community use the overnight carry trade. If I sell the US dollar to buy the Aussie dollar, you have to pay 0.25% interest on the US dollars that you borrow to finance the purchase of Aussie dollars. Because remember, to buy the exchange rate, you sell US dollar to buy the Aussie dollar. Now, if you're trading 1,000 lots, we're going to use some hedge fund examples here, because these are the kind of positions they'll be taking. You're paying 0.25% to borrow the dollar, but you're getting paid 3.25%. So every day you hold that trade open, over 365 days, a hedge fund will be making $86,000 a day on that trade. Versus, if I sell the Aussie dollar to buy the US dollar, I'm paying $86,000 a day over 365 days if you're a hedge fund, okay? Look, if you're taking a normal lot position, one lot in the currency pair, or you'll be making $8 a day. If you buy the Aussie dollar, you'll be losing $8 a day, okay? But we're talking about hedge funds here. The people who can move the markets because they're trading huge positions, okay? And it's important you understand how they're trading, because it really does move currency pairs, okay? So look at this example. As the Australian central bank, after the market crashed, the Australian central bank starts to raise interest rates. So look, it goes from 3.25% to 3.75 to 4 to 4.5%, okay, up to 4.75%. The central bank in Australia kept raising interest rates after 2009, okay? The US central bank did not raise interest rates at all. They remained at zero until 2011, okay? So look what happens. The reason this currency pair goes up 75% is because the hedge fund community are using this overnight carry trade to earn free interest. Because look what's happened when you bought the currency pair and now rates go from 3.25. Look at this number here, how much you'll be making every day. 3.25, 3.5, you're now making 90 grand a day. 4%, 100 grand a day. 4.25%, okay, hedge funds are making 115 grand a day. 4.5%, hedge funds are making 123 grand a day. 4.75%, hedge funds are making 130 grand a day to sell the US dollar, buy the Aussie dollar. That's the overnight carry trade. Every night you hold the trade open, you get that free interest credited into your trading account. Okay, and then what do you think hedge funds are going to be thinking to themselves? Well, if I catch that move from the bottom, I'm not just going to get all this $100,000 a day credited into my trading account. I'm also going to make a 75% appreciation in my Aussie dollars if I hold the trade open. That's what causes big trends in the markets. This is what's recently caused the big trend in US dollar against the Aussie dollar. It's the same fundamental reason. And the reason hedge funds right now are slashing their bets for a weaker yen is because the carry trade is coming to an end, just as it came to an end over here in 2011. Because look what happened over here. After that 75% move in the, after the 75% move in the Aussie dollar, US dollar, after the 2008 financial crash, why did the currency pair hit a peak? Because the overnight carry trade had flatlined. The Australian Central Bank stopped raising rates at 4.75%. So the traders in the hedge fund community are no longer using the carry trade. And that's why the contracts on the COT report hit its peak in 2011. Investors are going to chase the trade as long as the free interest keeps getting higher and higher. But when the free interest hits a peak because the central bank in Australia is no longer raising interest rates, the currency pair doesn't move anymore. And then the Australian Central Bank started cutting interest rates in November 2011. No surprise, look what happens. This is when the Aussie dollar starts to weaken against the US dollar. Why? Because hedge funds who'll be making all this free interest every day they hold their trade open, the moment rates start to go down, that 130 grand a day now starts to turn into 123 grand a day, will now start to turn to 100 grand a day. So you're not making as much money, but more importantly, as they close the trade quickly to lock in this profit, you don't want to be the one who made 75% and next minute you're only making 50%. If you keep holding it, it could go down to 38%. So as soon as interest rates get unwound, in terms of a higher interest rate in Australia now going lower, the overnight carry trade starts to get unwound because investors are trying to cash in on the carry trade. Those moves led to an unwind in the so-called carry trade. So now you understand what hedge funds are doing. They're always buying a currency where interest rates are going up compared to another currency. It can go up rapidly, like we saw in the US dollar Japanese yen exchange rate, or it can just go up steadily, but as long as interest rates keep going up, you can get a 75% move. Or if you look at the USD JPY, when the Federal Reserve started raising rates in 2022, when they first started hiking, it was right here. Okay, dollar yen went up 40%. So as long as the interest rates keep going higher, the currency pair keeps climbing. And now you're seeing the markets betting on rate cuts in the United States. As you can see over here on our spreadsheet, this is the spreadsheet where you can see meeting by meeting where interest rates are going. The reason the dollar is getting sold off against the yen is because interest rate cuts are coming. So the overnight carry trade, where investors have been cashing in on higher rates in the US, are coming to an end, because the difference is going to go from 5.5, which is where the interest rate in America is, and interest rates in Japan are at 0.25. If the markets have it correct, and by next year, December, rates go down to 3% in the US, look how much overnight carry is going to change. It's going to go from 150 grand a day to 80 grand a day. And the markets are predicting the Bank of Japan to raise rates by 0.25% to 0.5%. So you're going to see a big depreciation in the overnight carry trade every day. So hedge funds are unwinding the trade because they'd rather cash in quickly now. If they've caught that 40% move, they don't want to be the one holding a trade when that turns into 30%. And trust me, when the overnight carry trade completely gets unwound, because the Fed's going to be cutting rates, this currency pair is going to be going down. Just like when the Australian Central Bank started to cut rates, that big move we saw, that 70% move in Aussie dollar, US dollar, literally disintegrated and went all the way back down. Okay, so now you understand the overnight carry trade is going to tell you when the contracts are getting bigger and bigger in a currency's favor, but you need to understand why. And it's always fundamentals. And now you understand why. It's the carry trade. It's a really good strategy you need to understand, because hedge funds are using this to pile into trades. And when the carry trade gets unwound, when the central bank's either cutting rates as they're expecting right now in America, or it could be the Australian central bank at that example starting to cut rates. The overnight carry trade doesn't pay as much. Investors want to lock in their profits and get out of the trade. So I have a solution for you guys. If you want to get your hands on the daily updates, okay, for the COT report, I'll have you. Okay, so come into my Telegram channels. You're going to see in the education channel, every single week you get the report. So you can see exactly how hedge funds are positioned. Okay, once you get the report, you're knowing whether the hedge fund community are building their bets for our currency to strengthen, or they're starting to roll their bets back. Okay. You can also download the spreadsheet. Okay. And you can see how to interpret it for yourself. Now, most importantly, as I've just shown you, the overnight carry trade is what drives the currency markets. So you do also need to understand, right, where the hell are interest rates going, because that's the main driver, okay, for currency pairs. And we also have another spreadsheet and daily updates, okay, in the resources channel, where we'll show you exactly the rate where central banks are raising interest rates. You can also download this spreadsheet, okay, and you'll be able to work out whether if you sell a currency pair or buy a currency pair, are you making money? Are you losing money? And more importantly, which direction is the interest rate difference going? Because the wider it goes in one country's favor, like our USD JPY example, when the Federal Reserve started raising rates, or in the Australian dollar example, when the Australian central bank started to raise rates, whichever currency investors can sell to fund the purchase of a currency with a higher interest rate and get that free interest, they're going to get big moves in the exchange rate, especially if that difference is getting more and more favorable in Australia, example here from 2009 to 2011, or the recent example over here, where the dollar went up 40% against the yen because of higher interest rates in the US. But now investors have cut back on their bets on a weak yen because the carry trade is becoming unwound. Okay? So listen to the headline. The pullback came after an epic rally in the yen tied to expectations the Bank of Japan will keep raising interest rates. That stoked a rethink around the global so-called carry trades, which involve borrowing a currency with lower interest rates, such as Japan, as I was just showing you, and buying assets in a nation with higher interest rates. That's the carry trade. If you don't have the data where the hedge funds are putting their money, as I've just shown you here, and you don't have expectations for where interest rates are going, it's going to be virtually impossible for you guys to catch the move. So get the spreadsheets, come get involved. If you want to even trade alongside us, look, I'll literally show you. We took that currency trade. I shared it with my members the other day, dollar JPY. Look at all the results, okay, that have been being sent by the members, okay? Look, I have members sending me screenshots of their profits. £800. This member made 300. This member made 1,300 following my trades. This member made £5,300 profit following my trades. He started with £250. Other members are making 3,400. The profits roll on. You can trade alongside me as well. There's an option for you to upgrade to get full access. You get the spreadsheets, interest rates, and I'll be giving you, more importantly, guys, when you get the COT report data, I'll also be giving you daily video updates explaining to you why I'm buying Bitcoin, buying gold, selling USD JPY, buying stock markets. There's a lot of education there for you guys. So guys, click the link below the video. You'll get access to my Telegram channels to get hold of the spreadsheets. I'll see you in the VIP channels. Please like, comment, subscribe. Let me know if this video added some value to you. And hopefully guys, I'll be trading with you soon.
Okay, cool.